Well, welcome everybody to the next episode of the Cross Country Super Podcast. And this episode is proudly brought to you by Zaga, generating stable, fixed income style returns with an investor-first approach. Why zig when you can Zaga? And of course, joining me, as usual on all of these episodes, is Jemma Sanderson. How are you, Jemma? Great to see you.
I'm well, thanks, Darin. Good to see your smiley face once again.
That's good. And of course, we welcome everybody who joins these podcasts and listens into them as well. Now, our special topic today is going to be, well, actually, it's a couple of things we're going to talk about. First of all, the transfer balance cap. And obviously, as an extension to that, pensions as well.
Yep. So, very exciting stuff.
It is fascinating stuff. And I suppose to continue on one of our other discussions that we had, one of the things that we were kind of anticipating at the start of the year, but it didn't actually quite eventuate, that the transfer balance cap was going to have another round of indexation applied to it, but that's not the case. So it's remained at its current level.
And to be honest, sometimes it's nice that things aren't indexed. So we only had it recently indexed, and it sort of jumped 2 lots in one go. So it's nice to have a bit of stability sometimes with that. But as we have discussed in previous podcasts, the impact of that not being indexed changes how the contribution caps are going to work. So it's they interact from that perspective. And again, with that indexation, how that flows through, you've got the situation where if people haven't fully used their cap previously, we've got that, the indexation and a proportion of that, it adds complexity from that perspective. So we had a transfer balance cap of 1.6 million to start with, and now there could be 300 different transfer balance caps that people have, and then everyone's got their own actual balance and transfer balance account that happens.
Yeah.
So it can be a really complex area to have a look at and try and wade through.
Yeah, it's certainly not straightforward. And I should have premised my earlier comments about indexation for what's now known as the general transfer balance cap.
Because that's right.
As you alluded to, the general transfer balance cap is basically the level across the board. But then you have to take into account in the context of your personal transfer balance cap, which was obviously what you were alluding to when you're talking about how much of the original transfer balance cap was used.
Yep.
And potentially how much of the first and second round of indexation was used as well.
Yep. It's it's nice and confusing from that perspective, having a look at it. And then the way that your personal transfer balance cap, again, that cap in itself could be 300 different ones. But then the way that overlays with your own personal transfer balance account, if you started at 1.6, so then that's your cap, you've got no unused proportion that you can then benefit from the indexation. But then if you've taken commutations out, that changes what your transfer balance account actually is. And you can end up with a negative account as well. So say your assets have gone up in value and you've taken out some commutations. So those debits come off your transfer balance account, and you could end up with the situation that you've got a couple of $1 million still in pension phase, but your transfer balance account balance is zero because your commutations have reduced that down. So you could then put more money into pension phase. So it's an interesting way that it all works, and to be aware of all of those things as well.
Yeah, it's an incredible interplay of the minute machinations of exactly how that threshold works, I find, and altogether completely confusing because obviously people, when we talk about is indexation going to happen, then people tend to concentrate on just the indexation aspect of it, and I've already used my 1.6 right at the start, so I don't get any benefit of that. But then, of course, as you alluded to, you've got other strategies where it's all about transfer balance account management as opposed to how much benefit can I get out of the next round of indexation or whatever changes might happen. I just find that interplay quite fascinating and pretty hard to really get your head around if you're not looking at this every day. I mean, obviously, that's why you're here,
Yes.
Jemma, because you are able to offer your expertise in these areas. But it can be something as simple as you talk about commutations to give you a little bit more cap space. So I know that one thing that is often talked about is the minimum pension, meeting the minimum pension. And if you go over that, perhaps you should use that as a commutation to generate additional cap space.
Yep.
There's all sorts of strategies like that, isn't there, to sort of manage that situation?
Definitely, and like that's the prime one, and particularly over the last few years when the minimum pension threshold was at half. So some people would be taking out their usual amount, say it was usually at 5%. They would take that out maybe on a regular basis, or maybe it was once a quarter, however that looked. And where the minimum was halved, it was worthwhile looking at the situation of, well, I'm taking out 5%, but I really only need to take out 2.5. So how do I treat that extra amount? And a lot of the time, if people still had accumulation accounts, so if you'd already maximized your transfer balance cap, a lot of people actually did have an accumulation account sitting there on the side above their that transfer balance cap limit. So you would do a lump sum from superannuation of that difference that had the benefit of maximising the pension account balance and therefore the pension exemption, and with the accumulation balance pulling that down, and therefore again that would be a lower accumulation, a higher pension exemption as a proportion from that perspective. So that worked out well. There's a bit of faffing around factor from that perspective. That's my favourite technical term.
You love faffing around.
Love it. I hate having to faff around, but I love using it as a term. It's a good term. The faffing around factor on that was challenging in terms of every time you took out a lump sum payment, you've got to calculate what the taxable and tax-free components are. And so once in pension phase, every pension payment has the same proportion. Whatever those taxable tax-free components were at commencement, that applies to the life of the pension. So we know what that looks like. If the balance goes up from $1 million to $2 million, whatever the proportions at the start were, apply. So that's straightforward. If it goes down, again, those proportions apply. With accumulation accounts, what happens with the tax-free component is you've got the way that works is you're looking at the crystallisation component and the contribution segment. And so those amounts are pretty much fixed. So whatever that tax-free component is fixed. And then the balance of the accumulation account is the taxable component. Now, whenever you take out a lump sum, the value of those two accounts or those two components on the day of the lump sum need to be calculated to determine the proportions that apply to the lump sum. So if you take out monthly payments, then generally the way you would do it is you do the first 6 months payments, let's say, if they're all equal to get you to your 5% total drawdown. You do the first 6 months payments, treat them as pensions because that's easier, and then you do the second lot to treat them as lump sums, or vice versa, however you might like to cut it. But then you've got 6 payments where you need to know the balance of the accumulation account at each of those payments to then calculate those components. So it's with the modern software, that's all very manageable, but you've got to wait until generally after year end to then figure out what those components are. And it's just a matter of having to, like, obviously figure out how the software works and deals with that. But yeah, there's a bit of faffing around required from that perspective. So when you have accumulation, the best way to do it is to take lump sums from accumulation to manage that. If you've fully used your transfer balance cap, or you don't have super above that, so you've got no accumulation account effectively, then you are looking at those commutations. And the benefit of that is, like you said, it frees up some cap space. So it's a partial commutation. It's then a transfer balance debit off the account, and then it just brings down the amount that you've had counted towards that transfer balance cap. And in the situation, so some people think, well, what's the point? Why am I doing that? Why do I need more cap space? And the consideration with that is, well, that's a very valid question, because you've got to, with partial commutations, they have to be prospective. So you've got to make the request that it's treated as a commutation before the payment is made. So what generally happens is we do a preemptive request from the member saying, if I go over my payments, then they are to be treated like this. So it's preemptive. And then they have to be reported, though, those debits each quarter. So within 28 days after the end of the quarter, those debits need to be reported to the tax office. Back to my digressed, as I tend to do. So with the reasons why you would try and free up some cap space, if you've already capped out, like you've got no more money in super at that time, is if, say, you sell your house and you do a downsizer contribution, and you don't have to be, you can be 99 and can do a downsizer contribution. It'd be nice probably to flick that into pension phase from a tax perspective. Now, if you're 99, maybe you don't bother putting extra money into super, but you never know. There's someone in Queensland, I think, who just turned 110. So
Wow.
if you've got those sorts of genes, then maybe making that sort of downsizer is worthwhile. So that gives you the space to start a new pension from that. And then the other consideration is from a death perspective. So if you become the recipient of a reversionary pension, then it's nice to have some extra cap space there to keep more money in pension phase in superannuation. Now, it doesn't have to be reversionary. If it's not reversionary, but a new pension, death benefit pension is started for you, again, having that cap space can just mean more money stays in pension phase subsequent to the death of your spouse from that perspective. So it's got benefits. Also, some people like to, if they do a withdrawal and recontribution, so the withdrawal comes out, if they don't treat it as a partial commutation, then if they contribute the money back in, their ability to start a new pension with that money, they might not be able to, because if they've treated it just as raw pension payments rather than a commutation, then they might not have that cap space available.
Yeah, it's really fascinating stuff. You're at the coalface, Jemma. I'm obviously not. But how do clients get their head around this sort of stuff? I mean, are they good at figuring this out, or are they completely confused? Because we're effectively mixing in a lot of components together with sort of one concept, if you'd like to call it that. That can really be convoluting, some what could be considered originally as basic concepts into this huge pot of, I can't follow where this is going. Yeah. I don't blame them, but so how do they go with that?
Well, most people that are at that level of assets where the management is worthwhile, they are in, they're people that have got a self-managed super fund. Every self-managed super fund has a tax agent who would be looking at this. Now, sometimes, and I don't know what the statistics are about how many people actually don't have a tax agent, but they do their own accounts and they still get audited and all those sorts of things. So I'd say that would be a small proportion, but I'm not certain. So if they don't have, they'd have a tax agent that would hopefully alert them to these sorts of things. But if not, but if they don't get alerted by their tax agent, then generally if they've got a financial advisor, the financial advisor would be telling them about it. Now, in saying that, we encounter a number of situations where the tax agent for the fund is the family's accountant that they've had for decades, and they do the accounts for the fund, but they're not looking at these sorts of things. It's not on their radar, and they might not have a financial advisor because their financial their super fund is property, or they're self-invested, so they're self-directed, so they're not looking at these sorts of things. And so sometimes we encounter situations where they're not in pension phase, and they could have well been in pension phase for years, if not decades, and they've been missing out on those pension exemptions. So you do encounter that from time to time. There is people talk. So there's that element of barbecue talk that does happen. And golf at the golf club, at the sporting clubs, the community clubs, at barbecues, a lot of people like to talk about how well their investments perform and things like that. Not everyone. And often we get that barbecue talk coming back saying, oh, well, I spoke to my friend Darin at, I saw him and he told me that he's in pension phase and he pays no tax on this. So what about that? And so if, again, almost like a village raising a child, a village educating everyone on how these things work. Hopefully that would be a prompt to then maybe go to your tax agent and say, oh, should I be in pension phase? What does that look like? And then that if that person is unable to provide that advice, they would then refer them out to someone who could. The other thing is that, again, involved in a super fund is you've got, even if you do everything yourself, it's got to be independently audited. So if that would be another sort of avenue where the auditor may pick that up and just alert the trustees from that perspective. But that can in itself be a challenge. Like auditors, the impost on auditors of what they need to do for the fee that they charge is a lot already. So this, again, strategy is not one of their considerations. They're looking, they've got certain things that they need to be auditing. So from that perspective, generally most people in this realm are advised. So they are relying heavily on their advisors to run with these things.
Yeah, no, I think that's fair enough. If you do rely on the other professionals that you're using to support this, you can obviously sometimes not realize that they're more from a technocratic background as opposed to a strategic background. And this is probably where it's going to make a bit of a difference as far as that goes. Now, Jemma, you alluded to something, and we've talked about reversionary pensions before, and you're not a fan of them, are you?
No, I'm not. And the transfer balance cap is one of the reasons that I'm not.
Well, yeah.
So,
I mean, so be that as it may, obviously we've just touched on transfer balance account and transfer balance cap management. Without creating that additional space, and if an individual gets a death benefit pension or a reversionary pension from their spouse or the member who's passed away, that creates a whole set of different issues as to how you've got to manage the cap space and
that's right.
your account, doesn't it?
It does. And if it's reversionary, it all depends on if it's reversionary or not. So there's different rules if it's reversionary to if you start a new pension from the deceased account. So the reversionary side of things, and this is where some people can be a bit misled on how it works. So one of the pros of that reversionary is that as soon as Bob dies and his account is reversionary to Mary, then that pension just continues on to Mary. So Mary has to receive a minimum pension for the year, all those sorts of things, and gets the exemption on both her own pension account, if she's got one, and Bob's. Now, the challenges that can arise there is, and again, one of the benefits of that is that pension exemption applies for 12 months from the date of death. So there's not a transfer balance credit with respect to Bob's pension for 12 months after his death. And the relevance of that is back in the reasonable benefit limit days, which a lot of people probably listening in don't remember, or they've scrubbed them from their memories. Back then, you could, if a spouse died, you could have your own reasonable benefit limit and theirs. Under these provisions, you've only got your own transfer balance cap, so you don't get to keep both. So what tends to happen is in the lead up, so Bob dies today, 12 months time, the value of his account at his date of death, that pops up in Mary's transfer balance account as a credit to her own account. So then she needs to restructure her own accounts, if her own pension accounts at that time. Now, generally that involves her transferring her pension account back into accumulation. So that would be your debit on her transfer balance account. That then frees up that space for her to have Bob's pension in place. Now, with that, if Bob's pension was higher than Mary's available space, then the difference has to be come out of super as a lump sum payment. So you can only keep in super in terms of a dead person's benefits, you can only keep in super an amount up to the survivor's own transfer balance account, effectively from that perspective. So if it's reversionary, you've got 12 months to deal with it. The important factors with reversionary is that automatically became Mary's account. She has to make sure a minimum comes out from that perspective, and it automatically counts towards her own transfer, her own total super balance. So that can then impact if she's like over the 3 million threshold at the end of the year. Also, if her ability to make contributions the subsequent financial year, all of those sorts of things, which people can miss because they think, oh, you've got 12 months. We've got 12 months before it's a transfer balance credit. That's the only thing that applies there. Now, the other challenge with that 12 months is that the credit is the value at the date of death. And you've got to report that on the TBAR, the transfer balance account report, to the tax office within 28 days after the end of the event. And the event isn't 12 months after Bob's death. When it's a credit, it's Bob's death. So you've got, if Bob died, at the end of the March quarter, you've got until the 28th of April to actually report the value of Bob's reversionary pension at his date of death to the tax office, and then that will pop up in Mary's account in 12 months' time. So that can be a challenge in itself. You can do generally a reasonable guesstimate based on portfolio values and things like that. But let's say it was the end of the March quarter that Bob died. The actual financials for that fund for the prior year may not even be finalised yet because you're still waiting on tax reporting for some unlisted funds. I know we certainly do wait well into the calendar year before we get that finalised so that we can finalise accounts, all those sorts of things. So it can take time just to get the previous year's ones done, let alone trying to trigger a value of Bob's account at that period of time or at that date. Also, you're then saying to Mary, so Mary, I know Bob died last week, but we need to calculate this. And so can you get us some statements for this? And can you give us figure out what? So, it can be a bit ordinary from that perspective for the family. So you sort of need a value of Bob's account at that period of time. Then in 12 months' time, when Mary needs to restructure her own accounts, you're likely to need another value of the whole fund at that time to determine, well, you know what Bob's value was, so you know what the credit will be, but how much of Mary's account can you keep in pension depending on her balance at that time, all sorts of other bits and pieces. So that's 2 extra points in time where you need valuations and a bit of faffing around. So that's one of the reasons why I don't like reversionary pensions. Plus, another area is that minimum pension having to be made in that year, and in the subsequent year, then Mary's got to make sure she takes out a prorated minimum of her own account before she, say, commutes it back to accumulation. Otherwise, she doesn't get the pension exemption on her own account. So it's like that element of it. A lot of people don't pay out the minimum or they forget because of that reversion. The other, that there's a bit of a tip there, is if you know when you're going to die, which I know sounds a little bit of a silly comment, but people are in palliative care or the like. So if Bob was in the hospice and things like that, is there any strategy that we should do in the lead up to Bob's passing? Make sure Bob's minimum pension has been paid before he dies. And that way Mary doesn't have to think about it. Also, that will reduce down Bob's account by that minimum pension, which means that the credit or the value at his date of death will be lower. So the credit will be lower in Mary's account 12 months' time. So there's ways that, again, it's all about transfer balance cap management from that perspective, with the ultimate aim of keeping as much money in super as you possibly can, as tax effectively as you can. So it's really all for, from a tax planning perspective there. So that's when it's reversionary. When it's not reversionary, then it's, again, a little bit different. So there's no urgent valuation required. What needs to happen is that the benefit has to be dealt with as soon as practicably. So let's use Bob and Mary again. Bob dies at the end of March. It's not reversionary. So in that financial year, Mary doesn't have a minimum pension requirement to take out with respect to Bob's account. So that's a bonus, because effectively, as soon as he's died, that has become an accumulation account, notwithstanding that you get to keep the pension exemption for that until it is dealt with. So Mary's got the ability to just be like, okay, I don't have to take a minimum pension with respect to that. We don't have to value it on Bob's date of death. There's no additional reporting there required. So then, as soon as practicably, the benefit needs to be dealt with. So what does that look like? So that would generally, in this situation, you're probably looking at 30 June/1 July. So in the lead up to that time, you can put in place all the paperwork for Mary to be saying, well, I'll start a new pension with Bob's account, but only up to my available transfer balance cap. So what is her available transfer balance cap? You're not going to know that until the 30 June accounts are done. And then to figure out what her pension balance is, she can commute an amount back from that to accumulation. That gives her that cap space to then start a new pension with Bob's account. And again, if Bob's pension, Bob might have accumulation as well. Bob's total account ends up being more than Mary's available transfer balance account, then the balance would come out as a lump sum. Now, that's having to go through that whole process of, is there a death benefit nomination? Is Mary the designated beneficiary? All those sorts of things. But on the basis that Mary would be, then that's the next step. And that's far simpler because it's just 30 June. You don't have to do date of death, 12 months after date of death, those sorts of things. You don't have to pay out the minimum pension payment, and you get you still get the pension exemption, other elements like that. So that's why my preference is for it not to be reversionary, because you can achieve the same outcome with good, robust death benefit documents to say Mary gets the money anyway.
It does
clear as mud, right? Clear as mud.
Well, the options sound a little bit more straightforward if it's not reversionary. I've got to admit that. But do you think people opt for reversionary because it's almost like an automatic thing?
Well, it certainly was a consideration. So again, back in the day, there was always this element of, if it's not reversionary and Bob dies, do we lose the pension exemption at that point in time until it gets dealt with? So there was, a bit of argy-bargy about that. When I say argy-bargy, not really. Back in 2004, there was an ATO ID, 2004 688. Now, that tells me that there was more than 688 ATOIDs that got issued that year, which is unbelievable. But at that time, and I always remember that one, so 2004 688, which effectively said, when you die and it's not reversionary, the date of death, it becomes accumulation. So back then, a lot of people had a panic thinking, oh my God, I'm going to lose the pension exemption. So purely from a tax perspective, they made their pensions reversionary. Now, the issue with that is, well, do you really want Mary to get the money? Mary's your third wife. You actually want the money to go to the kids from the first marriage. So you don't want it to go to Mary, but all of a sudden Mary is the beneficiary of it. So there was that. And then subsequent to that, it was in 2011, there was a paper that the tax office released, and I think it was 2011, a draft, and then that got finalised in 2013. The pensions ruling about when a pension stops and starts, 2013 5. God, now I'm testing my memory. And at that point in time, they said if you die and it's in pension phase without reversionary, it becomes accumulation. However, the law then changed to enable the pension exemption to continue to apply until the benefit was otherwise dealt with. as soon as practicably was at that point in time. In 2017, that as soon as practicably element was actually removed. So that was interesting. But the SIS regulations require you to deal with death benefits as soon as practicably anyway. So it just enabled the pension exemption to continue to apply. The other thing that those changes came through at that point was also looking at the tax components. So let's say Bob had 3 pensions in place. One was 100% tax-free, one was 100% taxable, and one was 50-50. Then if everything became an accumulation account as at his date of death, did all those components just get aggregated and all the benefit of having 3 pensions is lost? Or do you get to sort of keep them separate until the benefits are otherwise dealt with? And the legislation again changed to clarify that even though all of those accounts became accumulation at date of death, so not only do you get to keep the pension exemption until they're dealt with, but those 3 accounts would remain separate from that the proportioning rule perspective.
I think you raised a really good point, and we've touched on this in the past as well, Jemma. Well, number one, the rule of thumb around as soon as practicable, roughly 6 months, is it?
So the tax office prefers it happening within 6 months. 6 months is not a long period of time. So sometimes, there's a hard and fast 6-month rule in the SIS regs about when someone dies, and for the fund to remain a self-managed super fund by definition. Then if someone has died, if their benefit hasn't been dealt with within the 6 months, then you need their legal personal representative to jump in as a director or a trustee. So that's the hard 6-month rule that's in the legislation. Sometimes you can't even satisfy that. So as an example, we had a client pass, and there was a bit of proper argy-bargy about his will, which one was current, because he'd had one executed a few years ago that appointed his wife as his executor, and he had executed one more recently where his daughter was the executor, but there was contentiousness as to whether he had capacity to execute the second one. So we spent 18 months in sort of dispute over which will was correct, and that was going to court to determine what that looked like. So in the meantime, the wife was the sole director of the trustee, and we alerted the tax office to the issue, saying, well, we can't deal with this as soon as practicably is not 6 months. We can't satisfy this definition within 6 months, because the chap's legal personal representative is, we don't know at this point until the Supreme Court tells us. So again, it's getting on the front foot from that perspective. So that's that hard and fast bit. But in terms of this, as soon as practicably dealing with this, again, you don't know the values of certain things if they're unlisted assets that have got quirky valuation requirements behind them. That's probably one of the bigger challenges, then trying to figure out what Bob's account was worth to then put in place all the correct mechanisms. Generally, you can make sure that the paperwork is appropriately drafted so that it captures those varying values, because, the values go up and down all the time. And then even today, I couldn't then go, oh, my super fund account balance is worth X with certainty, because there'll be some franking credits that the fund is due. There'll be some tax on some contributions that the fund may not have. There'll be pay-as-you-go quarterly installments that maybe the fund has paid, and how those get calculated through. So there's always those challenges. So I feel like between 6 and 12 months is generally appropriate. So in the situation, Bob's died at the end of March. If Bob had died at the end of July, then again, depending on the sorts of investments in there, I think that you could still look at the following sort of 30 June, 1 July. It's an easier way to do it. It's more practical to do it, or practicable to do it from that perspective. But it's also then just managing, again, the fund. So a lot of the time, money has to come out. So effectively, if Bob had a big accumulation account as well as a pension, rule of thumb, his accumulation account's probably going to have to come out as a lump sum. So then you're trying to manage, what's that worth? Because there's always leftovers as well. And now we've digressed into death benefit planning, but what's that worth? What assets are we moving, or what assets are we keeping? So if there's a big illiquid asset in there, like a property, do we move that out? What are the implications of that? Do we keep that in there? Is that going to generate enough cash flow to pay out Mary's minimum pension payments, which in the first year are a bit higher? Now with Div 296 in play, the considerations there might be, okay, well, this is a great asset to have in the super fund because it's capital growth, and then we get the gain at 10%. But then over time, that benefit gets eroded by perhaps you having to pay Div 296 tax on the unrealised gain over time. So it's managing. There's a few different chess pieces that need to be strategically placed in order to get that through. So anyway, keeps me in a job, Darin, which I probably say every single time. And I love, I like the problem solving element of all of these, but it's I guess a bit of a shame that there's a problem to solve.
I just love the way that whenever we talk about this stuff, and we talk about this stuff ad infinitum, not just on the podcast, that nothing ever seems to get any easier. We're always talking about situations of, now with the $3 million cap, that layers on another level of complexity to any of these strategies that we talk about. I just marvel that no one ever sits in the policymaker's office and say, how could we actually make this a little bit simpler?
Don't you remember complex. When it was Simpler Super?
Well,
Simpler Super that's back in the day.
Forget about that. That's out the window now. In fact, we should never even probably marry those two words together anymore. Simple and super. Forget about it. I know that was a catchphrase. I know that's what those reforms were called back in the Costello days, but no. Completely obsolete now. Yeah. So getting back to the as soon as practicable thing, is the 6-month time frame what you use to alert yourself and your clients to this is going to take longer than that? We better tell the tax office about that. Is that kind of how that rule of thumb works?
I think it depends in the context of what might take longer. So in the situation where we had that dispute as to who the legal personal representative was, get on the front foot and just alert the tax office, and just to let them know about that element of things. And then, of course, the auditor from that perspective as well. With the dealing with the pension account as soon as practicably in order to get the pension exemption and also satisfy the SIS regulation, then from that perspective, there's no hard 6-month rule. It would be where, and that's why within 6 to 12 months is usually about right. If you were starting to, push it beyond that, so it's been 3 years and you haven't dealt with the account yet, but you're still claiming the pension exemption. Okay, That's interesting. So that would be something a bit more from an alarm, a red flag consideration. So within a 12-month period of time, I would consider not inappropriate from that perspective. The other thing, just with we're adding complexity to all these scenarios because that's like life. But for some people, they might only have one transfer balance event in their whole life, and that is them starting the pension. And then they take their regular pension payments out, and then they might die before their spouse. So then they're done. Or they might have like two, or I'll call it three. So one's their pension starts. The second one is when their spouse dies and they get a new pension. And then the third one might be them having to restructure their own account and move it back from pension to accumulation. And then after that, they plod along perfectly happily. So there's a lot of where people start to have higher balances than the transfer balance cap, and you're trying to optimize their position for the longer term, because we're talking here, you know, people start these. So the transfer balance cap applies to retirement phase pensions. So a retirement phase pension these days, you've got to be 60 to qualify and have met a condition of release with a nil cashing restriction. So that's where your preservation age is kicking in. So that's the first thing to consider. So if you're 60, you could still have 40 plus years worth of you know, wanting to get the most out of this, like longer than your working life, and your retirement life may well be, you know, could be a longer retirement life than your working life, which is something awesome to aim for. So from that perspective, you want to make sure that you're optimizing that position. And a lot of people, when they do retire, they, you know, holidays, new car, boat, maybe those sorts of things. So managing that overall tax position is important because it's got long-term implications. And then likewise overlaying that with, you know, your Div 296 tax and those sorts of things. So, yeah.
Well, the person who's 110 years old that you mentioned at the start of this podcast, well, if they stop working at 60, well, they've survived 50 years after they've stopped working. If they live for another 10 years, that will be it. Equivalent of
nailing it. Yep.
Yeah.
Well, as again, digress, my grandfather was a fiery in the UK, and he was retired for longer than he worked. So he got that regular, you know, defined benefit sort of pension over there for 20 years longer than, I guess, the life expectancy. So he passed when he was 95. So he, you know, he got a good out of the UK government back in the day. So, yeah.
Wow. Now, the point you just made about, you know, people potentially not having to do a lot once they start a pension, you know, like a couple of significant events, and that's about it. You know, there's always this talk about T-bar and obviously the new reporting time frame regime where everybody's gone on to a quarterly reporting basis. Do you think sometimes there's a little bit too much made out of that, insofar as we talk about T-bar and there can be this sort of implication that there's an obligation to report every quarter now, but in actual fact, you're only talking about reporting things that affect your pension.
That's right. So it's only if there's a reportable event that you report it. So that would be that would be starting a pension, a partial commutation, if you become a reversionary recipient, and they're the main ones, really. The other thing is that there's a quirk there about LRBAs, and if you pay off one from an accumulation account, from a pension account, like I haven't seen one of them come through. It's usually the reporting, you're talking about pension restructures. So, you know, you're commuting back to accumulation for a death benefit pension, or the partial commutations, really, from that perspective. So again, you could happily plod through life, your retirement life, with only one event happening. But there is that cap management and cap planning that you indicated earlier.
Yeah, fair enough. Now, I know we've touched upon this in other discussions that we've had, but obviously, again, if we're touching on the transfer balance cap, it would be remiss of us not to, again, sort of cover briefly the interaction it has with some of the other thresholds, because we all know that the superannuation system seems to love to have multiple thresholds interacting with one another. And just to make it simple, none of them are pegged to anything remotely similar when it comes to indexation or any sort of adjustment like that. Clear as mud, really simple. Again, don't use that word with super because it's not simple anymore. But the transfer balance cap obviously interacts with total super balance, and those other thresholds. We'll just quickly talk about that, because obviously that's got an impact on whether or not you can make any non-concessional contributions anymore if your total super balance is over a particular limit. And of course, it's linked to this cap.
Yep, that's right. And again, so the interaction between them is that benchmarking of the upper total super balance threshold for non-concessional contributions to the general transfer balance cap. That's how that link sort of works. I again get other people say, "Oh, I can't make any more non-concessional contributions because I've fully used my transfer balance cap back in the day of 1.6." Like, okay, yep, that's a good starting point. But what's your account worth now? Oh, 1.7. Well, are you aware that you actually can make more contributions because that, your personal transfer balance cap might not have been indexed, but it has been indexed. So, that's how that sort of relates. And I think the biggest consideration for next financial year 24-25 is the fact that the contribution thresholds have been indexed, but the transfer balance cap, the general transfer balance cap, hasn't. So that upper level is staying the same, but because the concessional cap has been indexed, that means the non-concessional cap goes up, and that means that the 2-year and 3-year caps go up, but the thresholds, the lower non-concessional threshold is $1.68 million in the current financial year where we're talking, and next year it will actually go down by I'll get it right, $20,000. So at the moment it's 1.68, 1.79, 1.9. Next year it's going to be 1.66, 1.78, 1.9, and that's because it's a function of what the non-concessional cap is. So, 1.9 less the single year cap gives us the second threshold. So because it's going up from 110 to 120, that's where that lands. And then the lower threshold is the 1.9 less the 2-year cap, which will be 240. So 1.9 less 240 is your 1.66. So, that's where they interact. The other place where this has an impact is the cap defined benefit income stream annual threshold. So if you've got one of those pensions in place, there was different rules with respect to the transfer balance cap, where you could have, so market linked pensions or term allocated pensions or TAPs, lots of different ways that these were classified, and you could have one of them in place, and because they were non-commutable, then you couldn't commute the amount above the transfer balance cap back to accumulation because of the nature of the pension. So what was allowable with those is you could have a higher transfer balance cap. So say the value of your market link pension was $2.5 million. So that would have a special value that was higher than your standard cap. But then whatever income, so you could have a higher asset value that's exempt from tax because of that. But then what happened was the income that you received, your annual pension drawdown, was subject to this cap defined benefit income threshold, which at 1 July 17 was $100,000. So it was the $1.6 million transfer balance cap divided by 16. So as the transfer balance cap goes up, then that threshold increases, and the 100,000 enabled you to have $100,000 tax-free of your market-linked pension income. Any amount above that threshold was 50% of it was then taxed at your marginal tax rate. So at the moment, with 1.9 divided by 16 is the threshold, it's about 118,750 or 250 from that perspective. So that's how that is benchmarked as well. One of the thresholds that wasn't indexed, that originally was benchmarked to the transfer balance cap just because of its number, it was 1.6 million, was the disregarded small fund asset threshold.
Yeah.
And so that was to do with, from a segregation perspective. So if you wanted to segregate assets within your fund to manage the tax exemption, then you couldn't do that if one of the members of the fund had more than that disregarded small fund asset threshold of 1.6. So it was like, okay, well, that's the same as the transfer balance cap. So that'll benchmark with that. Yeah, you'd think so, but no. So it stayed at 1.6 as the transfer balance cap has gone up because that's an unindexed threshold. So just to watch out, saying, oh, well, I'm under my 1.9 in my total pension account or my total super, therefore I should be able to segregate that asset to my pension account, etc. Well, no, it's 1.6 has remained that particular threshold.
Yeah, it's absolutely amazing, isn't it, Gemma? As we often refer to as off-piste,
Yes.
with all of these other issues, it actually is a really good illustration of how intertwined all of this stuff is.
Yep.
But again, how conscious you have to be of, okay, so one threshold moves, one doesn't move, because I mean, obviously, exempt current pension income is a huge thing
Huge.
with
Yep.
with pensions. Otherwise, probably you could ask, why would you even bother to do it? So when you're talking about disregarded small fund assets and still that $1.6 million threshold, uh, it does nothing else but confuse people, I reckon.
Well, definitely. And there's been some changes on that front in the last few years because of that whole segregation and not, and just like the proportionate approach that might apply across a fund, because often it's easier to get an actuarial certificate for $100 than to try and distinctly figure out which areas. And so the legislation changed on that front, where if that was the situation, and I'm not going to go through it because that's a whole session in itself, is you can use the proportionate approach if you could use the actual segregated approach. You can use the proportionate approach if you want to. So that was at least a good outcome there. But I mean, that's the fundamentals of why do we bother starting a pension. So we've met a condition of release with a nil cashing restriction. Let's use our transfer balance cap and start a pension. Well, why? Why would we do that? Well, because then the underlying assets in that pension account, that retirement phase pension account, are exempt from tax on the earnings.
Yep.
And that's the fundamental thing. Now, to your point, a lot of people are like, oh, okay, that sounds great. Okay, but you've got to take out a minimum. It's 4%, 5%, 6%, and it does ratchet up really quite quickly. Oh, well, I don't need the money. A lot of wealthy families, oh, we don't need the money. We don't want to pull extra money out of super. So sometimes it's, again, more that tax planning of the total family group to get the benefit of that. And for other, and what at least what they take out is tax free. But for some people, they're like, look, our assets in the fund, they are shares that don't pay dividends, so we don't have that taxable income. It's we're land banking a block of land. The income that we're generating from the assets in there that do generate an income, it's not meaningful enough to benefit from it, because the taxable income of the fund is not very high. So why would we then pull this money out? So again, it's a planning consideration. And interestingly, and I'm not expecting a lot of people to remember this, pre-Simpler Super, which was 2007, there was a requirement that once you hit 65 and you weren't working, you had to draw down from super. And you could only keep it. So pretty much most people then went into pension phase because they had to, if they couldn't justify it by saying, well, I'm still working, therefore I'm still in accumulation. And you had to work something like 1,040 hours a year, or now I'm testing myself, or 840. Anyway, that's what that looked like. But they removed that. So you could effectively have your money in accumulation, well, until you die, and not have any drawdown from that perspective. So that was, an interesting change that happened back then. So if we consider, like, we transfer a time machine to now, and we look at the situation where, like, at that time, a lot of people were like, oh, well, why wouldn't I put all my money into pension phase where I get a tax-free pension drawdown and the underlying assets are exempt from tax? I mean, that was just a complete win on both elements. So we had that 10-year period, golden era of those people who were able to add lots of money into super before then. And then that got benchmarked down to your 1.6 million. But then you had all these accumulation accounts. If you had to benchmark down, all these accumulation accounts sitting there that are just plugging on, only like paying 15% income on 15% tax on income, 10% on realized gains. And so, how much there's going to be that massive transfer of wealth out of super. And because people aren't having to draw down as much in that situation. So you can almost see to some degree where because of that previous drawdown, like a more substantial drawdown of say 5% of the total fund rather than 5% of the amount up to your transfer balance cap, the super is getting, actually accumulating somewhat from that perspective. And then with your three, you overlay the $3 million. So anyway, there's all these different things that you can consider. The other thing, sorry, I just wanted to touch on with the T-bar is, yes, it's moved to quarterly. And so for the funds where it was an annual thing, that worked quite well. They were less than $1 million. The challenge with that, though, was if someone commuted and then rolled over to another fund, and sometimes they would end up with an excess because the timing of the reporting didn't line up. So that's quite important to try and get it done on a more regular basis. But the other thing is that there are penalties for not reporting within that 28-day period. I'm yet to see a penalty imposed, a late lodgement penalty from that perspective. So, we've had T-bar in place since from 1 July 17 was when the rules first came out, were effective. So we've had T-bar from that in place for a while. Obviously, there's still issues with just that timing, and so it's the tax office must be alive to that by the fact that they're not imposing late lodgement penalties at this point. But I feel like it'll be on the horizon from that perspective.
They're coming, Jemma.
Yeah.
As sure as eggs,
Yeah.
they're coming.
Yeah.
We don't necessarily know when the ATO will obviously change its position on this. And I suppose it depends on how long their patience will be with giving you some sort of grace period to get your affairs in order. And then at what point they decide that, well, we've had enough time now. I think we've been generous enough. Bang.
Yeah.
We're going to start enforcing this. It's going to happen. I mean,
and it's going to be there also the systems. Does the system alert the fact that, okay, well, that got lodged today, but it reflects a transaction that happened, in July 23. So actually, that's the disconnect or the reference point. Anyway, so just as a trying. Again, it's that education process of we've got to report these. So looking at quarterly. Have there been partial again, back to your question earlier, well, what is reportable? Starting a pension, partial commutations, really, and or like more full commutations because of death. But you get generally going to be on top of that. It's going to be the partial commutations where people are taking out more than their minimum. That's what you want to be on top of.
Yeah. And just quickly, you did allude to the situation one situation with market-linked pensions. Are there any sort of other issues still with the way that they interact with the transfer balance cap? With obviously trying to manage one of these pensions out, because they're probably a legacy issue that are unwanted, but are restricted as to what you can actually do with them.
So back, I think it was 2021, there was a budget announcement to provide a 2-year amnesty to remove the legacy pensions. And there was sort of 2 steps to that. One was the ability to restructure one. And then if you got an excess transfer balance cap or account notice, you could commute from that legacy pension. So that legislation came through in 2022, I think 23. So that enabled you to restructure one of those accounts. And then if you ended up with an excess, you could commute from that account back to accumulation. The other one was the situations where you might have a legacy pension in place that's a throwback from a Centrelink perspective, where you wouldn't have an excess transfer balance cap that would arise. So the restructure of that wouldn't give rise to where you could sort of manage it a bit better. And so we're still waiting on legislation that enables that amnesty to occur. So if you've got one of these cap defined benefit income streams, market linked pension, complying pensions, and you would have an excess transfer balance account, you can actually generally manage that at the moment and get rid of most of it or some of it from that perspective. But if you're sort of under your transfer balance cap, you're sort of stuck there a little bit. Save for the complying lifetime ones, you can restructure them to a market linked pension. And at least then that can deal with a reserve, because the challenge with the reserve is that if you die, the reserve becomes the funds and it can't get paid out when the member dies without other challenges coming through. So those sorts of pensions, they're historical from reasonable benefit limits. So that's pre-2007. The complying lifetimes are pre-2005. So we're talking like a long time ago, and you had to be 55 back then, being preservation age, for these to be put in place. And so, those people are starting to get, they're knocking up 75 to 80, and they're less concerned about pension exemptions because there's quirks to the transfer balance cap when you do commute from a market link pension, because you don't get to fully use your transfer balance cap effectively. The pension payments you've received since 1 July 17 reduce your available 1.6 million. So that's, a challenge in itself. So the people that we are encountering in that situation, they're less concerned about flexibility and simplicity as opposed to maximizing that ongoing tax exemption. They are also concerned about the death benefits tax on those accounts as well.
Yeah, well, obviously the reserve situation continues to be a bit of a problem because there's not only are reserves no longer allowed by the ATO, they don't consider the contribution reserve to be a reserve. But there's also restrictions about how quickly you can exhaust a reserve as well. So it's almost like a bit of a double whammy there.
Yeah,
which,
totally.
Obviously.
But then a triple whammy, again, off-piste, a triple whammy because a reserve, people want to be able to allocate them, but you can't except within the contribution limits. Yeah. But a reserve doesn't count towards Div 296. So you've got that whole, do I want to get rid of the reserve because then it's not trapped in super versus, but if I keep it, then it doesn't count towards my Div 296. So what do I do? The dilemma.
Of course.
Yeah.
Of course they'd throw these things up. I mean, as I said, it's not supposed to be easy.
No.
Anyway, but it's good for us. Gives me something to write about. Gives you something to do. Keeps us both out of mischief. So that can't be a bad thing. And as usual, we've had so much fun that we've run out of time again.
Standard.
Yeah, it is standard. So look, thanks again for your time, Jemma. It's always a pleasure putting together these podcasts with you. So thanks again for sharing your time all the way in Perth.
Yeah, thanks very much for having me. And, as I'm a self-confessed big nerd when it comes to all these sorts of things. And it's just educating people so that everyone gets the best outcome, I think is how we operate.
Just occurred to me I've failed my mission because I didn't make any references to The Simpsons or Star Wars today. So
yeah, neither did I. What were we?
I know. What were we thinking?
What were we thinking?
You've got to focus on these things.
Focus, Darin. Focus.
Statement. Absolutely. Anyway, we hope that if you've tuned in, you've enjoyed the discussion as much as we've enjoyed bringing it to you. I just want to give a shout out to those people who are listening to these podcasts on YouTube. Please don't forget to subscribe to our channel and also absolutely smash that like button so that we can sort of get our stats up. That would be really good. But apart from that, we hope you've enjoyed it. As I said, we've loved bringing this to you. Obviously, we'll be doing more in the future. But thanks again, Jemma, for your time. And thank you very much to all of you out there for joining us and listening to this podcast. Thanks again, and we'll catch you next time.